Welcome to today's municipalbonds.com webinar on muni investing post-election. I'm Matt Butcher, VP of Sales here at municipalbonds.com. Today's webinar is brought to you by the DRL Group. Today's presentation will be about a half hour long and be followed by a brief Q&A. Please submit your questions for the Q&A using the webinar cockpit anytime during the presentation. Any questions we don't get to will be followed up after the webinar is over. I'd like to introduce your host and presenter, DRL Group's principal and owner, David Lesh.
Thanks, Matt. Appreciate that. I'm going to go ahead and share my screen and welcome everybody. I hope everybody's having a good day. And before I forget, happy Thanksgiving to everybody. I hope everybody has a great time with their family and try to put the COVID stuff out of your mind for a while. That's important. So anyway, we're DRL Group. I'm David. I work with a team of traders and back office folks that we've been doing this for about 26 years now, and only in the high grade slash corporate bond market, muni bond market, and corporate bond market. So that's who we are, and that's our legal whatnot. So wanted to kind of push that to you and see that. So part of the webinar, we wanted to kind of go back and talk about what happened during COVID. There was a lot of things that happened in our market that were really unprecedented. If anybody listened to our last webinar, this slide here, you'll recognize that. In 2008 and 2009 versus COVID, we kind of compared the two and looked at how they overall reacted. In 2009 and 8, you know, munis moved lower. It just grinded lower every day. I mean, it just seemed like every day you came in, they were lower. In 2020, during COVID, March and April, I mean, bids effectively just collapsed over a matter of days. It would seem like hours, really, but it was a matter of days as opposed to 2009. COVID really wreaked havoc on dealers. Most dealers were heavy in inventory going into March. There was a tremendous amount of new issuance that was being done February and January of 2020. And most of those bonds didn't settle until middle to the latter part of March. And we all know what happened in March. So sadly, a lot of dealers got stuck with a bunch of inventory in February's prices as opposed to where the March prices were. That wasn't really a case in 2009 or 8. New issuance was relatively pretty light, and dealer inventories were pretty light going into 08 and 09 as well. So, you know, it wasn't that big of a deal. It could be absorbed through the dealer community, and you know, looking back on that, it worked really well. Retail clients bought into the 08-09 muni bond slash market disaster, whereas in the COVID problem, retail really didn't want to own very much at all. They were very skittish, very scared. Obviously, airports and stadium, as I have there, no one wanted to own any crowd type bonds. And so retail backed away fairly quickly and very, very aggressively. We had a gap down in bids, and in 2009 and 2008, the Fed acted relatively slowly. If you guys remember TARP, that kind of went to the bench 2 or 3 times before it got done. The Fed actually acted very, very quickly for COVID, and it really worked well, and it worked well for the muni bonds. Mutual funds played a really big part in 2020 for COVID. If you own mutual funds, the next slide, you'll give a pretty good idea as to what ended up happening, but that's mutual fund inflows and outflows. Obviously, that big downward V is during COVID. So you can see where so much came out of mutual funds, and it had a huge devastating impact on mutual funds and on the investor. We saw huge outflows. Mutual funds really tried to sell the junkier type securities where no one was purchasing bonds at all. No one was buying junkier paper, so they were forced to sell the high grade paper, AA rated, AAA rated, single A rated. And there was a bid, although the bid was low. They ended up selling a bunch of those bonds and leaving the investor with really junkier type paper. Mutual funds had to continue to sell in order to meet the net redemptions. And as an end result, the reality was that the investor was left with paper that they didn't think that they were buying in the first place. We had several funds during that time come and talk to us about bidding on paper, and we ended up buying quite a bit of paper, but we bought paper obviously at distressed prices. That is a graph of AA rated revenue paper on the muni side. Obviously COVID, which is identified there in the gray box, that was the overall yields and whatnot going through COVID. And as you can see, and I know the bottom axis, the horizontal axis is pretty small, but that high point was 2018. So as we moved into 2020, 2019, as a bond investor, as you already know, yields have continued to move down. And obviously we saw some volatility during COVID, but as we saw the yields spike back up and then come back down after the Fed put into the liquidity facility, that's what really made yields move down. And that was that large spike down right after that gray box. 2020 right now, in October, that purple box there, yields have been moving down significantly. And that's effectively 11.2. And then yields continue to move down prior to the elections. And then we'll talk about the elections here in a little bit. During the elections, the 10-year Treasury bill, that's intraday. So you'll see on the bottom, November 3rd, November 2nd, and November 4th. Look at November 4th. So as the elections were coming up and people were thinking we would have a blue wave, yields moved down pretty rapidly and pretty incredibly low in a very short period of time, where people were moving into treasuries, which was impacting the high grade munis as well. We think personally, and we'll get into this just in a little bit, that yields continue to grind lower. So this is a graph of what's going on in the muni market today. There's something out there called a AAA rated baseline curve, and we use that to bid on securities, whether they're AA rated, AAA rated, or single A rated. And we use that to have some sort of benchmark to look at what we're bidding. And so you guys can see where AAA rated paper, 2028, that's a 0.66 all the way up to 2050, which is a 172. There are some outliers on that graph, those yellow dots up above. Those are some small municipalities that did some deals, but that's a pretty good research tool for dealers like us as we're acquiring product. You can bid based upon a benchmark. The change, of course, is in basis points. That's the green numbers in the center. So talking about the elections, kind of shifting off munis for a second, it's funny how the market is usually right. If you've been investing for a period of time and you look at, how the market has done and what the market originally kind of thought about the elections, you'll see the white line is Biden, the blue line is Trump, and they kind of cross paths back there February of 2019, and Biden kind of got traction, as we moved into June, July, August, September, October 2020. And it is kind of interesting to look at how these markets viewed the overall election. And from a dealer capacity and from a dealer perspective, pretty much everybody was betting on a Biden win. I mean, it wasn't a secret. People were out there thinking that, okay, Trump's got an uphill battle, and, people were putting on positions knowing full good and well, or at least anticipating that Biden was going to win. Obviously, no one really knew, but everybody was anticipating a Biden win. Sure enough, the equity market, well, this particular graph here, which is a graph on Bloomberg, it for sure said that. And what was interesting is that last date is November the 5th, And on November the 5th, I mean, obviously the graph just goes haywire. So, you know, it's pretty evident Biden is going to get in at this point. We as dealers, most of the muni bond buyers out there and most of the muni bond dealers out there, such as ourselves, believe that, you know, Trump is not going to contest it any further. I mean, he's definitely going to contest it from the standpoint of saying that the election was fraud. But at the end of the day, we kind of think that Biden is going to get in. As far as the Georgia situation, we reserve comment on that. You know, if something should happen where the Senate definitely goes to the Democrats, that's going to change the dynamics of the way taxes are going to be viewed. Right now, the dealer community and most folks on Wall Street think that the Senate's going to hold Republican and things will move. But that's an interesting graph, and it is funny how, you know, definitely think things go the way the market thinks, for sure. This is COVID. This kind of puts it in perspective. So moving into the muni bond market, you know, you look back in 2008 and 2009, you'll see where the Fed dumped money a bunch into the Treasury market. They did TARP. They started their buyback program. They did a lot of things that they said, okay, look, we're going to support this debt and we're going to support it. And at the time, I think it was around $800 billion or so. At the time, that was a huge, huge move. And no one, of course, had any idea what that set of, it just was incredible because there was no precedent to be set prior to that. Obviously now, looking forward, fast forwarding to the graph all the way to the right, you'll see where COVID, you know, the total was right at 3 trillion. There were 3 individual bills passed, as you know, 2 of which had the municipal lending facility in it. And you can see the difference between what happened in 08 and 09 versus what happened in 2020. And by the way, as a reference point, the 2008 and 2009, that took a while to get done. And it was very nerve-wracking going back to that original slide. So things just continued to go on and on and on. Whereas now in COVID world, it seemed to just move so incredibly fast. It stuff got done really, really quickly. Sales tax are definitely a concern through COVID, and it continues to be a concern even with the Pfizer news and the Moderna news. You know, with the vaccines coming in, you know, obviously it's very, very concerning to see how sales taxes are going to be impacted. Red is bad, white is good, blue is better. So the darker the red, which I'm sitting in Houston, Texas, obviously Texas is being affected, whereas Colorado and these other states, Washington, Idaho, so on and so forth, you know, it's really not that big of a change at this moment. So when we're buying bonds, or when you are buying bonds from your broker, you know, if you're buying sales tax bonds or any type of bonds that have anything to do with, you know, any type of outside general obligation debt, you know, make sure that you pay attention to what state you're purchasing, what kind of, you know, what's behind the debt, you know, what's being paid, and what kind of recourse do the bondholders have, or the trustee has in the event of default if they're not insured. Most people out there, including us, believe that taxes are going to increase, particularly with the Biden administration, despite the fact that Georgia might continue to be a Republican state. Most folks believe that taxes are going to increase. And for the simple reason is because, I mean, this debt that's been issued for the last, call it 9 months, 8 months, it's going to have to be paid for. And I know that we've all said that, you know, how are we going to pay for this federal debt? And that's been a big debate for a very, very long time. But $3 trillion is a lot of money. And there's probably going to be another package passed once Biden gets into office. I think the Pelosi and Schumer and Biden and Congress will go through and get another bill passed. And most dealers out there, including us, thinks that there's going to be another deal done. And I think that deal, by the way, will enhance the liquidity lending bill that's been passed. So what does that mean for a bond buyer? Well, I mean, at the end of the day, interest rates are going to have to stay low. Federal taxes are going to have to go up. taxable equivalent yields on munis are going to have to go up. So whatever bracket you're in now, I would probably add, between 4 to 8% onto that bracket for 2021. No one really believes it'll be retroactive, so I don't think that's going to be an issue. The muni tax exemption is not going to be messed with. There's been some questions on whether they're going to try to mess around with the muni tax exemption. We don't believe that that's going to happen, nor does anybody else for that matter. However, real estate transactions, 1031 exchanges and of the like, a lot of folks, they believe that, that's going to be targeted pretty heavily in 2021. So if you do a lot of real estate or have 1031 exchanges, make sure you talk to your tax person about that. Troubled states such as New Jersey, New York, California, Illinois, those kind of states, they're going to continue to increase their overall taxes to cover their budget shortfalls. California has actually done a pretty decent job. Illinois, New York, and New Jersey are coming along a little bit slower, but nevertheless, it continues to be a pretty good overall outlook, and pretty sure that most taxes are going to move up federal and most likely state as well. People living in California, New York, and New Jersey, they've already started talking about, increasing taxes from that standpoint. That's an interesting chart. So the actual kind of orange line are yields on 30-year treasuries. The white line is the amount of issuance, debt outstanding. So it's kind of crazy how it crossed there in 2010 through 2014. That was actually about 2011 where it crossed. And it's kind of crazy how it crossed. The debt continues to go up, but yields continue to go down. And if you really ask yourself why, look at, go on CNBC or any other Yahoo Finance or any other type of website that you use and look at foreign currency and look at foreign debt and look at their debt. Just look at the 10-year versus our 10-year, and you're going to see why overall debt in our world continues to move down. The sad part about it is we're the best house on the block because, we're still a positive, whereas several others are negative, 0, or point something, very, very small for a 10-year. So you see a lot of money continuing to shift into the treasury markets, which ultimately help munis as well. What the Fed has indicated, from a muni bond perspective, and really from a bond buyer's perspective, whether you buy munis or corporates, they have said with very clearly that, hey, look, we're going to do whatever it takes. They see sizable downside risk. They're going to continue to see sizable downside risk. What's been interesting is that the bid list that we're seeing as dealers, as the last 5 to 7 days, maybe even 12, we've seen a lot of shorter term paper come out for the bid, and a lot of longer term paper being purchased. And people aren't really banking on saying, okay, I'm going to buy a 15-year piece of paper because I think yields are going to be lower in 15 years. What they don't want to do is buy a 1 or 2 year piece of paper and then be matured or called and say, okay, yields are going to be lower in 1 or 2 years. So we're seeing a lot of that trade go on. The Fed has stressed that there's going to be definitely sluggish productivity growth for sure. I found it interesting that in their beige book, they actually mentioned worker skills are wasted, which was quite interesting. That's actually a quote from them. They've said that, there's been a lot of various wasted skills in this whole COVID situation. Obviously, potential bankruptcies, that's a given. The Fed has indicated that there's not going to be a rate hike through 2023, end of 2022 to be exact. Some people are even suggesting 2025. I think personally, my honest opinion, if anybody tells you rates are going to stay steady through 2025, that's a hard thing to even say, quite honestly, even through 2022. But, everything indicates that rates are going to stay steady, and that's really all we have to go on at this point in time. I personally believe rates move in October of 2022, so a couple of years from now. And I think that most people are in that camp, particularly in the large dealer community. That graph kind of points out the inflation, and it calculates when rates should move. The Fed said, hey, 2% inflation, we should be good. 2% inflation, that's a 1-year average, 3-year average, and a 5-year average. Most folks believe, and inflation, by the way, is that dotted line, that dotted horizontal line. That puts it out to 2024. So, you know, that's a graph coming off an economic chart, and that graph was generated September 23rd. So it is a bit old, but it hasn't really changed at all. It's still the same. At the end of the day, you know, most folks believe that 2024 will be the overall thought process of the Fed actually moving rates. Again, I'm not suggesting that's going to happen. I'm just saying that's what's predicted out there. I would say 2022 for sure. What we saw as a dealer community is we saw a huge supply surge. If you look at that white graph there, dealers out there look at the amount of product that is looking for a bid. The bid is defined as a price. So you have 25 bonds in Houston, Texas, where I am, and you need to sell those bonds for some reason. You tell your broker to get a price. That's called a bid in our world. So you need a bid on those bonds. And so when we're looking at that, that bid flow is extremely important. At the end of 2017, that was actually the tax changes that Trump put in. 2019, you saw a tremendous amount of activity due to coming into 2020. There was a lot of tax swaps in 2019. And then obviously in 2020, you've seen it hit that green line pretty close to 2 times. And obviously one of those was COVID. So bid side flow is extremely important to us. Y'all seen that graph below again. So, I mean, as we say, yields continue to move down. And today, our thoughts are that municipalities in November were rushing to get deals done. And if you go back to that graph where you see that yield right before that purple box, municipalities were rushing to get stuff done because of the election. Everybody was like, pre-election yields moving up. Oh my gosh, I got to get my deal done. Okay, well, if you're going to have a lot of municipalities rushing to get things done, you know, in our world, it's not rocket science. If you got a lot of product hitting the market, I mean, most stuff's going to trade cheap, and that's exactly what happened. So stuff started to trade cheap. So that's the reason why you see that yield graph go up there before purple as opposed to go down. So yields continue to go down. That was the first time we saw AA rated insured paper trade at a 3% in a very, very long time. And we sold a lot of that paper to our clients and other clients at that time because, you know, it was a hard sale, and I won't be, you know, I'm not going to sugarcoat it. It was tough to get accounts to buy 3% because everybody wanted higher. But at the end of the day, you know, that was the best deals we were seeing. And obviously now all those are gone. The shorter end of the curve, it definitely traded off. That goes back to my comment a little bit ago where, you know, we saw a ton of overall short paper sell, and volatility was huge during that time, which obviously is a good thing from a dealer perspective because we're able to buy paper, just like in COVID, we were able to buy paper. Now, you know, what's happening is that we knew the Fed was going to intervene back in COVID. So now people are going, okay, well, yields are moving up in November. Is this going to be another COVID situation? Well, most folks thought that, well, the Fed would be intervening one way or the other. And, you know, it gave people a lot of comfort. So dealer today versus May of 2020, you know, or March of 2020, I mean, at the end of the day, we felt relatively pretty good in November, even though we saw yields moving up and moving up pretty significantly in a pretty quick period of time. But going back, I mean, you know, we thought that, okay, this is most likely that rush to market that you would see. So our thoughts on Biden from a post-election deal, I mean, Biden should be good for munis. He's going to be pretty relaxed, we believe, on municipalities, on the Puerto Rico, on the Virgin Islands, on the Guam of the world. I think that overall, I think that he's going to be very pro fourth stimulus package. And most people are believing that that's going to happen. State and local municipalities, that goes back to that fourth stimulus package. They're going to get the assistance that they need. There's no question about that. You know, the Biden campaign is going to make sure that most, if not all of the municipalities, and that would be the California, Illinois, New York, New Jersey, Washington, Connecticut, those states are going to get their assistance for sure. There's been a lot of airport and healthcare municipal rating changes for 2020. Obviously, that's pretty self-explanatory for airports. Healthcare, as you guys, all you guys know, the elective surgeries have been put off. They're dealing with COVID. They're not making a bunch of money on COVID. Your specialty hospitals, like here in Harris County, which would be MD Anderson or Texas Children's, and wherever you live, y'all all have specialty hospitals. Those hospitals are doing very, very well. But when you get into the regional hospitals, they're not doing well. And they led ratings changes for 2020. We believe Puerto Rico will benefit from a Biden administration. As discussed before, I think he's going to be very pro Puerto Rico. And I think that in the overall split in government, and I know I'm bouncing around on the actual bullet points, but a split in government, it's really not going to stop munis. I mean, there's a negative $14 billion of issuance that come through in 2021 at this moment. And what that means is that pretend you had $100 worth of bonds called and you only had $50 worth of bonds to purchase. So that's kind of what you're looking at. So 2021, despite the fact that rates are probably going to stay steady, despite that there's probably going to be another stimulus package, there's 14 billion in negative net issuance. And the reason why, it's pretty self-explanatory. We already talked about it. There was a whole bunch of issuance in November. So a lot of people in October, a lot of people got their stuff done already. That right there is muni sales from the standpoint of they are definitely slowing. And that's net issuance. So as you can see, October, high point, everybody got their deal done. Hurry up, get to market, let's get it done. We don't know what the Biden administration or the Trump administration is going to do. Concerned about taxes, let's get the stuff done. You see how overall supply has continued to shrink from the standpoint of new issuance, and that continues even today. And that's the liquidity facility. So we've talked about that a little bit. So that was really important. And this slide is very important if you're a municipal bond buyer. What this really means is that Mnuchin and Chairman Powell and Trump and his administration and everybody in Treasury, they recognized that there was an issue with municipal bonds. And in March and April, the bid side was completely torn up, meaning that it went down. Prices went way down, as you already know if you're a bond buyer. And it happened in 08 and 09 too, when the Treasury back then, Hank Paulson, came in and said, okay, to Timothy Geithner, we need to do something about this municipal bond market. They issued what was called a municipal liquidity facility in 2020. And that is actually set to roll off in 2021 or December of this year, or 1/1/21, however you want to look at it. And the issue right now is that, are they going to extend it? Is there going to be a fourth stimulus package? And is that fourth stimulus package going to include something like this? And most of the economic community and the dealer community, hedge fund community, and mutual fund community believe that there will be a fourth stimulus package done, and it will contain something like this, if this is not, by the way, extended. Chairman Powell took a lot of heat on this deal because there was only two borrowers that have actually tapped this facility: the state of Illinois and Metropolitan Transit Authority, that last bullet point. And the reality is that the tapping of that was exactly what Chairman Powell did. He gave the option for the municipalities to have a backstop to use if they need it. But what ended up happening was that also gave dealers like us, and everybody else for that matter, the confidence that these municipalities had the ability to go tap this stuff. So with that said, most municipalities went to the primary markets, and they were issuing paper in the primary market. So as you can see, on March 23rd, 2020, the third bullet point from the bottom, rates shot to 288. That was 10-year paper. And now rates have gone down. That was as of 10/26 to a 0.95. So you saw how this municipal lending facility did exactly what it was supposed to do. It provided liquidity to the marketplace and provided confidence to the overall muni bond investor. And it was a huge win for everybody. I mean, that's when it happened, that point there right in the center of the graph. And then that's when yields, started to climb ahead of the elections, and that was fund flows. So, that is really brings it to one of the last slides is the mutual funds and why fund flows matter. I mean, we do not purchase mutual funds. You don't control your destiny. Mutual funds need to continue to, create liquidity for any type of outflows that they have. And usually when a fund is selling, there's a reason for it to be selling, and most of them are leveraged as well. And then lastly, we're high grade buyers, and we've been high grade buyers for a very long time. Our shop focuses on, AA rated and AA rated insured paper with the occasional AAA rated and maybe the occasional single A rated, primarily non-AMT. And that's a good graph right there as far as yields and where yields have gone and what yields are doing. So yields currently continue to grind down. Bid lists continue to shorten up and get much tighter. And it seems like if you bid on 100 items, it used to be where you had 12 to 15, maybe 18% of those items trade. Today, it used to be, meaning like at the first of this year. Today, you would have maybe 5 to 7% of those items trade. During COVID, by the way, if you were lucky to get a bid, you had maybe 15% of those items trade, maybe even 18%. So we saw quite a bit of volatility in the COVID world. So that's really an overview of really what we do, what the Fed did, the lending facility or the liquidity facility, from a standpoint of interest rates. Taxes are going to go up, most likely, and taxable equivalent yields should go down. And the conclusion of rates is that rates will continue to move down. There's no real anticipation of rates going up anytime soon. And the dot plot says that, Chairman Powell will not be moving rates between now and 2022 for sure. Again, it's tough to do. From an overall Q&A standpoint, there was quite a few questions that were asked. So from the standpoint of saying, okay, hey, look, how are we going to address these questions? We selected a couple of them from the standpoint of saying, it's pretty applicable to most of the audience. And one of them would be, given the deficits in municipalities, how does COVID rank and are bonds a good investment? Because I can see where a listener or a viewer would say, look, how are these municipalities servicing their debt? I mean, if they don't have the sales taxes, what's going on? And the reality there is that we're not really buying the questionable municipalities. And I wouldn't advise that either. If you're buying a general obligation bond that's BB rated and not insured, then there's a reason why that's BB rated. One of those first slides we looked at, it's funny how the market is always right. If it's yielding more than what it should be and it's BB rated and uninsured, there's probably a reason, and we're not doing that. Quite frankly, we think that there's going to be more defaults in the municipal market on uninsured paper for sure. Small municipalities, small regional airports, hospitals, small stadiums, convention centers, stuff like that. And that's why if we're going into that arena, we're only buying insured paper. So, we're trying to focus on that. Another question is that what's the focus on, MTAs, which is Metropolitan Transit Authority, New York, stadiums, airports, how do we view all of that stuff? So let's just put that into a classification of a COVID trade. The way we view that trade is that, you look at LaGuardia, if any of you are in New York, or you look at Houston, which is where I am, or DIA in Denver, the airports are going to be around. There's no question about that. We're going to get a vaccine. There's a lot of smart folks working on this thing. And, people are going to go back to the normal way of life. Are they a buy now? Well, I mean, look at the RCLs of the world or the Deltas of the world or any type of transportation type UAL, they have done very well, particularly over the last 3 to 4 days after the vaccine news last week from Pfizer. If we're buying insured paper, we're definitely going to look at it pretty strongly. We're definitely buyers of airport paper if it's insured. And we're definitely buyers of different types of COVID type stuff. The stadiums, we look at stadiums as long as they're insured. And then the question becomes, one of the questions was, how good are the insurance companies based upon, servicing debt from a COVID standpoint? And the answer, which leads me into the next question, is that it depends on what insurance company you're buying. We only buy AGM, AGC, BAM, Berkshire on occasion, and that's really about it. We don't really buy any type of MBIA, FIGIC, AMBAC, National, NATL. We're not really buyers of that. Actually, we're not buyers of that, period. And we stick with those insurance companies because they have plenty of what's called claims paying resources to pay the municipal debt should the municipality either file for bankruptcy, reorganization, or whatnot. BAM and Assured was just reaffirmed in July of 2020. So we feel fairly confident that they're going to continue on. And I can tell you that all through COVID, really, even though everything was down, I'm not going to pretend that it wasn't, BAM and Assured paper traded very, very well. They traded it was very liquid. We always got a bid on the stuff. There was always multiple bidders, and that was very comforting to see. Whereas MBIA, FIGIC, AMBAC, and National, there was questionable bids from the standpoint of what actual issue was going to happen. And then I'll leave the last question. This will be the last thing, Matt. There were several questions about, will municipal bonds be taxed eventually? And that's really a very very speculative question. I mean, and during the Obama administration, municipal bonds were attacked, and they did try to address the taxation or the tax exemption of that security. They were obviously unsuccessful, and it's been on the radar for a very, very, very long time. The reality to this question is that I don't think personally, and obviously most of the dealer community doesn't either, but just from my personal thought, I don't ever think that'll happen. And the reason for that is that, small municipalities or large municipalities can't compete with a taxable offer. If you're gonna make municipal bonds taxable, the interest taxable, then you would have to compete with the Boeings of the world, or McDonald's, or Walmart's, or whatever, Exxon's, or name a company. So, if the municipal bond interest becomes taxable, municipalities will have to obviously raise their levies or their taxes or their property taxes or water and sewer usage fees or whatever to compete. Because if a municipal bond, let's just use the city of Houston where I am, if they need to issue a bond at, say they're issuing bonds at a 2.5%, and now they have to be 3.5% to compete with, say, the Exxons of the world, as an example, then no one's going to buy that. No one's going to buy a 3.5% taxable or 3.25% taxable when they could buy Exxon. And I use no one pretty liberally or pretty loosely, but the reality is the municipality is going to have to either meet or beat the taxable market. And so you sitting there at your computer, wherever you are, say you're in Denver, Colorado, how would you feel if your tax bill came and it was up quite a bit, and you called your council member or your congressman or whomever and said, hey, what's going on? Why is this up? And they're going to say, hey, look, you know what? The interest we're paying now is taxable, so we have to compete against the Exxons of the world, and you're going to be pretty upset. So, I don't think that the Congress people will allow that to happen, because that's really their constituents, and they're going to really be careful about making their constituents upset on that type of deal. At the end of the day, when the rubber meets the road, yes, it's been talked about, it's been proposed, it's never happened, it'll never happen. And that's something that, oddly enough, got a lot of questions on that, but everybody out in our world, at least, feels that that's not going to happen. So, anyway, that was the last question. If you should you have any others, just email us or call or whatever. We'll be happy to do that. And that's it, Matt. I appreciate the time. That puts us right at 40 minutes or so. And hope everybody again has a terrific Thanksgiving. And I appreciate your time. And hopefully this was informative. And if you wish to see this again, it'll be on our website. It'll be recorded. You can go through it as well. So thank you very much and have a terrific day.
Thank you, David, very much for your time. And thanks everyone else.